Ever wondered how banks make profit? You deposit your money, they safeguard it, and even pay you interest. Yet, they continue to thrive. What's the secret behind this seemingly paradoxical business model? Well, the answer lies in the diverse ways banks generate income. It's not just about holding money safe in vaults, it's about strategically using that money to create more wealth. Commercial banks, for instance, operate on a simple yet effective principle. They accept deposits and lend out that money to businesses and individuals. The catch? The interest rate they charge on loans is higher than the interest they pay on deposits. This difference, known as the spread, forms a significant chunk of their revenue. Investment banks, on the other hand, have a different approach. They don't accept deposits. Instead, they assist corporations in raising capital through issuing and selling securities in the capital markets. They also provide advice on mergers and acquisitions and earn hefty fees for these services. Retail banks, a familiar face for most, offer a broad range of services, from checking accounts and savings accounts to issuing credit cards and providing personal loans. They earn from the fees charged for these services and from the interest on loans and credit cards. Then there are online banks, the new kids on the block. With no physical branches to maintain, they save on overhead costs and often offer higher interest rates on deposits, attracting tech-savvy customers. They make money in much the same way as traditional banks, but with lower operational costs, they can pass on the savings to their customers. Now, what about central banks? They play a unique role in the financial system. They don't seek to make a profit. Instead, they manage the country's money supply, set interest rates, and act as a lender of last resort to commercial banks. Their goal is to maintain economic stability, not to make money. So, whether it's through the spread between interest rates, fees for various services, or assisting in big-ticket corporate moves, banks have multiple revenue streams. They are not simply vaults holding money, they are dynamic institutions that actively work to multiply wealth. In summary, banks make profit through lending at higher interest rates than they pay on deposits, charging fees for services, and in the case of investment banks, helping corporations raise capital. Each type of bank has its unique business model, but all of them, with the exception of central banks, share the primary goal of making profit. The world of banking might seem complex, but once you understand the underlying principles, it becomes clear that banks are businesses like any other, striving to provide value to their customers while ensuring their own financial health. They are a critical part of the financial ecosystem, facilitating transactions, providing loans, and helping economies grow. No matter which way you look at it, banks are more than just money holders. They are money multipliers.